Hi, this is Nick with Supportive Financial, and today I want to go through the Genworth class action letter. You may have received this if you have long-term care insurance with Genworth, and I just wanted to go through exactly what is being said in the letter and to give you some examples of what those potential options are. This is not a video to tell you which option to choose. This is simply just to give you some education on some of the terms that they're using and also some key points in each option that I want to make sure that you know about before you make a decision. So let's dive in. So the first part of this letter details that Genworth is part of a class action settlement and that this is a way for them to make good on this settlement by giving you some options that maybe they wouldn't have given you before. A few pieces of information on this letterhead to keep in mind. First, it says that this is not a rate increase notice. This is simply that they're giving you options that you can choose, and you can also do nothing. As it says, you are not required to choose any of these options, and you may instead keep your policy as is. I think the best line in here is the one right after that, where it says, before making an election, please discuss these options with your insurance person, your advisor, your family members, and anyone else that needs to be aware of this decision. So one of the pieces that is maybe scaring a lot of people is that they're talking about the potential for rate increases. So they're throwing a lot of large numbers, 639% of an increase. Now, but that's on something that someone who has lifetime benefits. Most of the time you may have a cap on benefits. So even so, looking at increases of 293% or 426%. Those are very large rate increases. Now, keep in mind they even put in this letter, any future premium rate increases have to be approved by the state. So this letter could be way off from what is actually done from the state, or it may be close. But this is, even though they're just seeking these increases, this is not an official rate increase. So Genworth still has to go to the state and get approval and prove that they need to raise these rates that much. So let's go into some of the options. They're broken into two sections. One where no more premiums would need to be paid, and then the other where there would be a reduction in premium. So let's kind of go through an example of kind of what that would look like, and I'll go through some of the terms so that you have a better idea of how this thing works. So I have to start off saying that this is not an actual person. This may not be exactly what is shown on your letter, but from the letters that I've seen, I've tried to come up with a hypothetical example just to help you go through and learn some of the terms. And maybe this will help you and your advisory team make a better decision. So the first set of options that are in this letter are what Genworth is saying is no more premiums required. That sounds great, right? But let's take a look at what we're giving up, because if we're going to no longer pay premiums, we're probably going to have to give up some type of benefit, right? So on the left, Genworth typically lists your current benefits, and then you can compare them to the other options. So option one, from what I've seen, is called it, what Genworth is calling it, an enhanced reduced paid up benefit. So at the cash payment line, if you chose that option, you would receive no lump sum cash payment. Your monthly benefit amount typically would stay the same from what it was currently was. However, there would be no more inflation rider or benefit increase. Typically, the elimination period is staying the same. So the elimination period is just the time from when you are approved for the claim and when insurance pays out. And typically, in a situation like this, 90 days if you have to go into a nursing facility means if you need to go into a nursing facility, you need to pay your own way for 90 days before long-term care would kick in. 0 days home care means that if you need skilled nursing to come into your home, typically the policy would begin paying right away. Now, here's where the benefits kind of make a major difference, is the benefit period. So you'll see that in options 1 and options 2, there's really no longer a benefit period. And the drastic change is the total lifetime benefit amount. So how the total lifetime benefit is calculated is that they take a look at what is your maximum monthly benefit amount multiplied by the benefit period. And that comes up with your total lifetime benefit amount. That's the pool of money that you have to use for this policy. Options 1 and 2 drastically slice the total lifetime benefit amount. And why would someone consider this? Well, the benefit there Genworth is saying is that, well, you'll have no more premiums to be paid. You'll have a policy in place and you don't have to pay another premium. The problem is you only have now, in this example for option 1, $95,000 to work with. And if you're paying $9,000 a month for a facility, that the benefit's gone in 10 months. So the key part of this review when you're looking at your letter is the total lifetime benefit amount and how much that is changing. The difference between option 1 and option 2 is that option 2 is allowing for a paid up option. So they're saying we're going to give you a large cash payment right now. So Genworth theoretically would write you a check for $8,000 if you select this option. But you'll see that, okay, what am I giving up? Even further, the total lifetime benefit is reduced. So talk to your financial advisor, talk to your family, consider this, consider the issues with these two premiums. Really, you would only potentially choose these is if you had some severe financial issue where you needed cash and you needed to end these premiums. But highly recommend you do not choose these options unless you consult with your family and your advisors. So let's take a look at the second set of options, which aren't so drastic in their change, but we still should review. So the next set of options are what Genworth is calling reduced benefits. So they're giving you options 3, 4, and 5, where the lifetime benefit amount does change, but it's not as drastic as those first two. So let's go down the list and see what these options are talking about, and so you can have a better understanding of the terms so you can make a more informed decision. So option 3 says we're going to remove the inflation benefit, revert back to the original monthly maximum, and we'll give you a $5,000 cash payment. In this example, remember, this is an example. Your options may be different. So what Genworth is saying is we'll give you $5,000 up front. However, this particular policy had a 3% inflation adjustment or inflation rider or a benefit increase option, which is that BIO. Now, depending on how long you've had this, when you first got the policy, every year, if you had the inflation rider, the monthly benefit amount increased, and in this case, it got to $9,000. So what Genworth is saying is, I want you to give up that growth of the monthly benefit amount, and we'll give you $5,000 up front and no longer inflate your monthly benefits. The elimination period seems to be staying the same for every option that Genworth is providing. The benefit period in this case is the same. So you'll see that the lifetime benefit amount, of course, decreases, but also the quarterly premium decreases. So this would be something to consider if maybe you were close to approaching, but you're giving up the inflation rider on this, and also you're giving up all that inflation before. And talk to your advisors, but as with everything, the cost of these facilities over the past couple of years have increased. So to immediately give up all of that inflation growth that you paid for, you need to take a hard decision and consider that. So option 4 is removing the inflation benefit, keeping the current monthly maximum, but just reducing the benefit period. So really look at the difference between option 3 and 4. You'll see that Genworth your monthly benefit will remain the same, meaning that they're not going to take away all that inflation growth that you have gotten in the policy, but they're no longer going to inflate it, and also they're going to cut your benefit period by a few years. So even though you'll have that higher monthly amount, it'll only last for so many years, and you'll see a large decrease in your lifetime benefit amount. So then option 5 is, I would say what I've been seeing is option 5's the one that has the least drastic change. What they're saying is we'll give you a smaller lump sum down payment up front. You're going to have a slightly reduced monthly maximum benefit. We're going to keep the 5% inflation adjustment, but we're also going to keep your benefit years. So when you look at the lifetime benefit, what I've been seeing is option 5 has the least amount of lifetime benefit decrease from all the options. But I'm not recommending any of these options. What I'm hoping that this helps you with is helping you read this document, removing the fear that may be created by getting this letter, and giving you some more tools that you can help talk to your family and your advisors to make a good decision. Thank you so much for watching. Hopefully this was helpful. Again, this is not a recommendation for any option, but hopefully by going through it and talking it out, you get a better understanding of what your actual options are. As always, if you have any questions, feel free to reach out, and happy to help as best I can. Take care.